Hello and welcome to today's webcast sponsored by the American Forest Foundation. The title is How to Ensure High Integrity When Purchasing Carbon Credits. My name is Jim Giles. I'm Vice President of Net Zero here at GreenBiz, and I'm pleased as always to welcome listeners from around the world. So we're going to dive in pretty quickly, but I just have a few housekeeping details to run through first. So the screen you're looking at has a number of features that I'm going to point out. As the slide you can see now shows, you can resize and move around the various windows on the webcourse platform to optimize your viewing experience. At the bottom of the screen is a toolbar with various buttons. You can download the resources from today's webcast by clicking on the button marked resources. And please note that this webcast is being recorded and the recording will be shared with all registrants later today. And if you have questions for today's speakers, and I'm sure there are going to be lots of questions, please click on the Q&A button and type your questions into the Q&A window that appears. We'll be fielding those later on in the program, but don't hesitate, put in the questions now and I'll filter them as they come along. You can chat with other attendees at any time by clicking the group chat button. And we'd also love it if you could make time at some point to take a really quick survey so that the foundation can better understand how your organization is using carbon credits. There's a link in the toolbar at the base of your screen to that survey. And as I said, you can do it at any point during the webcast. Finally, feel free to share what you're learning with your Twitter network by using the hashtag GRNBZ. That's GreenBiz without the vowels. Okay, housekeeping out of the way. Let's get on to today's discussion. So we are in the midst of a long overdue and much needed surge in the number of companies committing to really genuinely ambitious climate targets. For many of those companies, aggressive reductions in scope 1, 2, and 3 emissions are being accompanied by an increased investment in carbon credit, particularly nature-based solutions. Now, there are countless case studies at this point that demonstrate the impact of high-quality nature-based solutions. But alongside that set of evidence, there's also an awareness that some offset projects has failed to deliver the hoped-for impacts. And of course, this raises the issue for companies who want to get involved in the space of how they can invest with real confidence. So in this webcast, we're going to hear from 2 pioneering nonprofits and a corporate buyer who together are going to help you understand that critical decision, the decision of how to invest in nature-based solutions with real confidence. We have a fantastic group, and I'll introduce them to you quickly before handing over to them. Nathan Truitt is the Vice President of Strategic Partnerships at the American Forest Foundation. Sam Moore is the Senior Carbon Advisor of the Global Carbon Markets Team at the Nature Conservancy. And Beth Witiaz is the Senior Vice President and Enterprise Climate Strategy Executive at Bank of America. Welcome, all of you. Okay, let's dive in. And I'm going to kick it off. We'll do some panel discussion with some questions from me at the beginning. And like I said, we will move on to questions from the audience, probably at the halfway mark of the hour or maybe a little bit past, but do keep those questions coming. Let's kick off with a question for Cam. So the team at Nature Conservancy, I know, has done quite a bit of research on natural climate solutions. So tell us what we know about forest's ability to provide a truly meaningful impact to companies who are looking to reach a net zero goal.
Thanks, Jim. I'll first briefly introduce the Nature Conservancy. So the mission of the Nature Conservancy is to conserve the lands and waters on which all life depends. And we were formed about 70 years ago and are now active in over 70 countries. And between now and 2030, we're really laser focused on trying to solve the twin interlinked crises of biodiversity loss and climate change. So 2030 is 94 months away, and we intend to make every single one of those months count and appreciate everyone else's help on this webinar in doing that. Natural climate solutions, or nature-based solutions as they're often called as well, are really an essential part of TNC's global priorities. And in trying to help you understand this, the first thing to understand about natural climate solutions is that living nature outside your window is made of carbon and other elements. But the trees outside your window right now are about 50% composed of carbon that was removed from the atmosphere as those trees grew. NCS, as we call it, natural climate solutions, are a set of strategies to protect, manage, and restore the world's ecosystems to allow them to sequester and store additional carbon. So this is everything from reducing deforestation in Central Africa to incentivizing using cover crops in agriculture in Nebraska. And we think that a seminal study in, I think, 2017 that came out estimates that the full global potential is about 11 gigatons, so 11 billion tons per year of potential climate benefit if we scale up natural climate solutions around the world. And the last kind of big picture point to make on this is the science is really clear that we cannot, be on a 1.5 C aligned trajectory without a ton of help from nature. So within natural climate solutions, forests are really, as you can see in the slide here, kind of the big behemoth. Many ecosystems, well, all the ecosystems are really important, but forests offer probably the largest sort of opportunity here. And when we think about natural climate solutions, we're really thinking about a range of approaches and tools, policy, greening supply chains, et cetera. But voluntary carbon markets play a really critical role here, both for the hugely important impact that these projects can have on the ground in climate and conservation outcomes, but also because they serve as really an innovation lab where we can test new science, new financial models, new partnerships that we can sort of ladder up into other fora like international policy, other corporate actions, et cetera. So, yeah, when we're thinking about carbon markets, like one of the most essential things is sort of the order of the day today is to focus on very high quality, which TNC has been doing a ton of research on for a while and really dedicated to. And to us, high quality is really about ensuring that the climate benefits of these carbon credits are real and of the magnitude that's being claimed, and also ensuring that there's real co-benefits and protections for communities and nature. And I always think of high quality as more of a cardinal direction than a destination that you arrive at, because societal expectations are constantly changing and new science and new best practice is constantly being created. So we should always be trying to bring the newest, latest, and greatest thinking to this space to make sure that we're producing the best quality carbon credits possible and never being satisfied with the status quo. So in that context, it's been a real pleasure to work with the Family Forest Carbon Program team for the last 3 or 4 years, I guess now, because that ethos of continual improvement has really been in the bloodstream of everybody at the Nature Conservancy and American Forest Foundation and other partners that are part of this collaboration. And Nate knows this painfully well, that we've built and torn up the prototype many times, which is painful, but necessary in order to always be on that bleeding edge of innovation, which is where we want to be at. I'll pass it over to Nate now.
Great. Thanks, Cam. That's a really useful intro. So, Nate, let's now look at the work that the American Forest Foundation is doing. Tell us a little bit first about your organization and then about the work that you're doing specifically on carbon.
Yeah, thank you very much, Jim. And thanks to GreenBiz for organizing this. And Cam and Beth, thank you for taking the time to join this panel. So yeah, I want to start by just giving people a very quick introduction about AFF. The American Forest Foundation, we are a national conservation organization, and we work specifically to support and enable family forest owners to make a positive impact on their land. So what does that mean? Well, across the U.S., the largest portion of U.S. forests, or about 39%, so that's the largest ownership group, are owned not by governments, not by industry, but by families and individuals. And these are properties anywhere from 10 to 10,000 acres, although they tend to average about 70 acres in size. Collectively, these families and individuals own more than 290 million acres of land. And to give you a sense of how big that is, that's basically the states of Texas plus the states of California, right? So it's a huge area of land managed by families and individuals. If we were all together in a room, I would answer the question of who are these family forest owners through the following exercise. I'd ask everyone to raise their hands if they themselves own a property with at least 10 acres of woods. And then I'd ask everyone to raise their hands if they know a family member or a friend who owns a property of 10 acres or more of woods. And through that exercise, typically, you end up with about 2/3 of the people in the room raising their hands. And so I then just would invite everyone to look around at each other, and I'd say, there, that's who family forest owners are, right? They're us. Now, they're distinct from other ownership groups in that they tend not to be, it's not their business to own a forest, right? They usually have another line of work, and they're owning a forest as a hobby, as a retreat, because they've inherited it, right? Because they want to recreate on that property. And so what they need, if they're going to implement the best kind of management, is a trusted advisor and resources to help them implement that management. And so that's what we at AFF view as our work. We operate across a broad coalition of conservation partners, companies, and policymakers to help create the programs, tools, and resources that enable those landowners to care for their land, and this is really important, get what they want out of their land, right? So we're not showing up to these landowners to say, you know, you really ought to do this. We're showing up to listen to what their goals are, and then to say, okay, we have a way of providing you the support that you need so you get what you want, but also society gets what it needs from its forests. And that's not only climate, by the way, it's the other things that Cam talked about, right? It's strong rural economies, it's biodiversity, it's clean water, it's a number of benefits. So we can now talk about climate change. Since 2017, working with the Nature Conservancy, we've really focused on how do we get family forest owners to adopt these forest management strategies that lead to additional carbon sequestration and storage. And just to say, you know, if there's this big opportunity for natural climate solutions, and 40% of the forests roughly are owned by families and individuals, you've got to engage them in order to reach that larger goal. So that's why we began to develop the Family Forest Carbon Program. We're going to get into some more details about the program itself and about what constitutes quality in natural-based solutions. But I just want to very quickly mention sort of four pillars we've always tried to keep at the base of this program. First of all, inclusion. Historically, these landowners have not participated in carbon markets because the transaction costs have been too high, right? So that's the number one problem we set out to solve, is how do you sort of design a program which allows a landowner with 67 acres to participate in carbon markets. Secondly, we focus on the long-term relationship with the landowner. So there's a lot of efforts out there right now that really rely heavily on technology to be able to say, okay, let's measure the carbon and let's deliver a payment, and let's do it very, very efficiently. And that's great. We use technology as well, but we also want to provide a landowner with trusted technical advice and assistance in the form of a forester who can come out and talk with the landowner about what they want from their land and how to get it and what sort of forest management is going to be needed along the way, and then to serve as a resource for that landowner along their journey. Because we feel that's how you're going to get durable climate impacts, right? Is by changing the attitude of people towards the land that they own. And that's not something, unfortunately, that can happen through an internet connection, right? So that's a second pillar. A third pillar is we've built a very complex and sophisticated financial model, or as Cam referred to it as the prototype, which balances the interests of all these different actors, from the companies that buy the credits to the investors who loan us the money to be able to recruit landowners, the landowners themselves, the foresters who work with them. And we're constantly tweaking that. We've gone through literally over 120 revisions of that model as the market has evolved, as we learn other things. But it's a very long-term model, and it's set up for iteration. And then the final thing I want to mention is that, like TNC, we are a nonprofit conservation organization. So our ultimate bottom line is focused on impact. And we are really devoted to the issue of environmental integrity. And we rely very much on our partners at the Nature Conservancy to sort of constantly inform us about the science that we ought to be building in. So that started with a new methodology, which we've written to both enable family forest owners to participate, but also to sort of raise the bar on questions like additionality. And I think Cam's going to talk about that more later. But it's also on a whole other range of issues, whether it's permanence or leakage, that we're constantly seeking to understand what these things mean and how we can make the program better. So we're going to dive into more of this, but Jim, I hope that answered the question at a high level of who AFF is and sort of what our priors are as we engage in this space.
That's great. Thank you, Nathan. Yes, we'll come back to more, we're going to get into more details on the program, but let's do our final intro first. So Beth, you don't need to introduce Bank of America. But perhaps you could tell us about the bank's high-level climate goals and how nature-based solutions fit into those goals.
Sure, absolutely. Well, thank you for having me today. It's great to be with everyone. So Bank of America is committed to achieving net zero before 2050, and that covers our operations, our supply chain, and our financing activities. And to date, we have announced our 2030 emission reduction targets for operations and supply chain. And I can tell you that I am right now working on our 2030 targets, our first ones, for portions of our financing activities to be announced this year. So a lot underway there. But really, as we've been on this journey to net zero, we had committed to achieve 100% renewable electricity as well as carbon neutrality back in 2015 as part of our overall commitments. And so we reached that in 2019. And so as we continue this net zero journey, we're continuing to maintain those targets as well. And that's really where, when we got to carbon neutrality, after reducing our scope 1 and 2 emissions by 60%, then we, of course, were purchasing all renewable electricity. And then that left a really small amount of unavoidable emissions. And that's where we began to purchase carbon offsets. And so really started the carbon offset or carbon credit journey back in 2018, specific to our use in operations and now also in business travel as part of our scope 3 kind of efforts there. I will just note too, outside of kind of the work that I do every day, the bank did used to have a carbon trading market in the UK and currently now has expanded some of our services to help support clients as they're looking to make similar commitments and exploring the carbon credit markets. So I'll pass it back to you, Jim.
Yeah, awesome. Thank you, Beth. So Nathan, let's go back to you and let's dig into the program in a bit more. But perhaps you could put that in the context first by giving us just like a quick take on the current state of the carbon credit marketplace and how the AFF is responding, and then tell us a little bit about the program itself.
Yeah, absolutely. And wanting to get to questions, I will try and keep this short. I mean, you can attend 5 carbon market webinars each and every day, right? And as an aside here, thank you all for attending this one. There's a report that comes out every day. There's stories that come out. There's so much activity. So I want to cut through all that to think about just 2 basic things that I see happening. Number one, there's rapidly increasing demand for voluntary market instruments for carbon credits, driven mainly by actually investors, right, who have come to understand that companies that are not aligned with a 1.5 degree target represent a financial risk. So these are not investors who are out to save the planet, although they may want to do that. They see these as essentially a good measuring stick for whether it is a sound or an unsound investment. And what that has done is that has changed this topic from one that existed at like sustainability conferences and among CSOs to now. That was the case when we started this program, Cam, I think 4 or 5 years ago. Now, this is a C-suite discussion in almost every company, right, of how you're going to comply with this. So that's one thing. Over 2,000 companies have set a science-based target. They've begun to make their plans. They've figured out how many credits they're going to need, and that's driving this spike in demand. At the same time, there's a group of institutions that are effectively creating a regulatory environment to make sure that these carbon credits have high integrity. And typically, when regulation increases, the costs of things go up. So you've got a situation where we're switching from very high supply and very low demand to very high demand and very low supply, and regulation is increasing. And that has fundamentally transformed the market. 12 months ago, would talk about the prices at which we sell our carbon credits, and about half of the companies would say, let me stop you there, we would never pay that much for a carbon credit. Today, we never get that reaction. And in fact, we are well under the prices that we hear in the carbon markets. And that's just been in 1 year, right? So that's what's happening. Now, how are we as project developers, and I would argue any responsible project developer, responding to this? first and foremost, we have to keep our eye on what that definition of integrity is going to be in the marketplace. And we have to constantly be innovating, right, to figure out how we're going to meet it. So a great example, just to touch on quickly, is the issue of permanence, right? What does that mean? Is it 100 years? Is it truly permanent? How do we calculate it? How do we ensure that it's going to be there? It's a very complicated subject, but we have to be aware of what the market is going to demand. And we have to be designing solutions to that. The other thing is, we as project developers, it's not just about the carbon credits we create, it's also about how they're being used. So it's incumbent on us to make sure that our buyers are, like Bank of America, committed to the mitigation hierarchy, right? They've done everything they possibly can to reduce their own emissions, to chart a path, and only when all that's been done do they turn to the issue of buying carbon credits to cover their residual emissions. I would say, to everyone involved or interested in carbon markets, the great thing about what happened at Glasgow with Article 6 negotiations is it formalized this notion that carbon markets are a key lever to keep us on a 1.5 degree pathway, which probably all of us on this webinar knew and accepted, but that's now been formalized, right, at an international level. That's great. Now, here's the challenge. We have to live up to that promise, right? We have to raise the bar ourselves to create higher integrity credits that actually deliver climate impact. And if we don't, we shouldn't just assume that agreement is etched in stone. We've got trust right now, but we have to keep it. We have to deliver on the promise, or else this amazing market mechanism is going to go away. So yeah, that's a lot of details around carbon markets, but that's the quick and dirty answer of what I see there.
Great, thanks, Nathan, and appreciate you identifying some really important trends there. Let's get into the details of these credits themselves. And Cam, I'm going to come back to you. Can you tell us about the Family Forest Carbon Program methodology, and particularly some of the things that you've done to add real credibility to this program?
Yeah, happy to do so. First, I'll just reflect that I've been in the space for a bit over a decade, I guess, a few years more than a decade, and it's kind of surreal to me that we're talking about methodologies in this context, and I think it's a really positive movement. 5 years ago, this was purely the domain of uber carbon nerds, and it's good to have buyers of these products get in the weeds on it, because I think, like Nate says, that sort of helps put the pressure to raise the bar everywhere. So in that context, just a bit of background for folks. Carbon credits that you buy on the voluntary markets are sort of regulated by these carbon standard bodies. Think of Verra, which oversees the VCS standard. And then in each standard, there's approved methodologies, which are like a recipe for creating the carbon credits. And project developers like us can propose new methodologies that go through a very rigorous process to get approved. So the Family Forest Carbon Program team has been working to develop this new methodology for I guess about 2.5 or 3 years here, that we think has a number of really exciting innovations that Nate referenced. But I'm going to focus just on one, which is about the baseline. And I'll warn that this does get into the weeds a tiny bit, but that is really where the innovation occurs. So establishing a quality baseline for a carbon project is, in my opinion, the single most challenging thing you can do in developing a good carbon project. So the baseline scenario, right, is basically it's a science-informed estimate of what would have happened in the carbon project area if the carbon project didn't occur. So by definition, it's something that cannot be directly observed. And that creates a lot of challenges, and also those challenges can be sort of a spark for really interesting and cool innovation, which is what we're aiming for here. This issue isn't particular to NCS projects. It's really for any carbon credit generating project. You have to have a baseline. That's what everything is measured against. So it really is very influential on the amount of carbon credits that are produced and the realness of those carbon credits. The key advance in the new methodology that we have developed, which is under the Verified Carbon Standard managed by Verra, is we're switching from what historically in these types of projects has been what we'll call a projected baseline to a dynamic baseline. The main difference here is in a projected baseline, you use information that you have today about things like timber markets. What are the prices for different wood products, state and national policies on, that regulate how family forest owner can manage their forest, common logging practices, things like that, to make a model of what will happen for the next potentially several decades. And then you're measuring what actually happens in your project compared to that baseline for a matter of decades. There's been a lot of great innovation in that space, but we all know that the world changes constantly and often unpredictably. And so there are some drawbacks to these projected baselines. With the dynamic baseline approach, which is kind of totally new, that this is the first methodology to use it, we're creating a new approach where the baseline, the thing you're measuring all the carbon benefits against, is continually self-correcting and basically functions like a giant experiment on the landscape. So this is where we get in the weeds a little bit. So the goal of our giant experiment is to see how much more carbon can be sequestered in the family forests that are in our program compared to very, very similar analogous forests in the same area with similar landowners that are not in our program, okay? So we actually adapted this approach from how the biomedical field runs experiments to test the efficacy of vaccines and other medical interventions, basically. We went way out of the carbon credit world and said, okay, where are there good models out there that we can adapt? So like any good experiment, we needed a control that represents what happens when someone does not enroll in the Family Forest Carbon Program and get all these great benefits that Nate mentioned. Fortunately, the U.S. Forest Service runs a really amazing program called the FIA that has over 100,000 plots around the U.S., so 100,000 measurement sites around the U.S. that are updated every year, or the whole data set's updated every year, basically. And this basically functions as like the nation's forest census. So that's the background. So in the Family Forest Carbon Program, how we run our big experiment is a landowner, maybe one of you on this call, like Nate said, several of the people on this call probably own enough forest to comply, raises their hand and says, hey, I want to join this awesome program. I want to get access to professional forester to tell me how to manage my forest and financial incentives to help me basically manage my forest sustainably and sequester more carbon. So they enroll, and when they enroll, we match them to plots from the data set of over 100,000 plots in the U.S. that the Forest Service manages that's publicly available. We match them to plots that are most similar to their forest on all the things that predict basically likelihood to harvest your forest. So the treatment is the person getting all the great benefits in the Family Forest Carbon Program. They're getting sort of a vaccine against bad forestry, you could say. And then the control is somebody who looks just like them. Actually, it's a blend of somebody that look just like them, in their county or in that immediate area that aren't getting those benefits. And then we see what happens, right? So we give our vaccine to the landowners in the program. We take on some risk. The program takes on some risk, like paying out money to help them do good things in their forests. And then the control doesn't get that, and the amount of carbon credits that we generate is basically the delta, the difference of that sort of accrues gradually over time. So you can think of that as, I think it's probably immediately apparent that that has a ton of benefits compared to a projected baseline approach where you just kind of make a model of what somebody would do for the next 40 years, but you're not updating it with new information. So like I said, it gets in the weeds a little bit, but I think the key takeaway is much greater accuracy and transparency. So this approach allows us to really confidently isolate the additional climate benefit, the additional carbon storage and sequestration in those participating forests compared to very similar forests that aren't participating. And this dynamic baseline kind of automatically factors in new data, new science to improve the baseline. So the state where the program is happening implements a new policy that governs how family forest owners manage their forests. Well, that gets automatically baked into it. Or increasing stress on our forests from climate change. That also gets automatically baked into the baseline. And then finally, I think the other thing that's really good about it is just the incentive structure is aligned right. So the Family Forest Carbon Program has an incentive to be always kind of outrunning the forests that are not in the program, right? So we have an incentive to come up with new and creative innovations to help eventually, hopefully, millions of landowners around the U.S. Manage their forests in a way to sequester more carbon. And then finally, like I said, we're developing this under the VCS, and it should be finally approved like any day. we sort of innovated out beyond the VCS rules, and so we had to wait until they had their basically annual update that they do to their standard, which happened January 19th. That was released, so should be done here any day. But they've been an awesome partner in this, and we're excited to get it finalized.
Thank you, Cam. Appreciate you getting into the weeds. I really like that analogy. Made a complicated thing clear. I see a ton of questions coming in. Some of them are about additionality. We are definitely going to get to those as quickly as possible. I got 2 more questions to the panel before we get there. Beth, just tell us about the kind of due diligence that you've done on your team when choosing carbon credits to invest in. Tell us a little bit about the process and how you got the buy-in to make that investment.
Sure, absolutely. I'll try to just hit the high points, and Nate and Cam can tell you we do conduct a good amount of due diligence and try to do our best in selecting projects and partners related to carbon credits. So I think I mentioned we really kicked off in 2018. The first thing we did was try to understand the landscape and learn what was out there, what guidance. At that time, interestingly enough, it really was just the WWF guidance that existed. And so to Cam's earlier point, this has grown tremendously. Now we have Oxford, we've got the Task Force for Scaling the Voluntary Carbon Markets, right? We've got the Integrity Initiative. So there's a lot more resources out there to help kind of guide as you move through this process. But in particular, I think there are a few things I would note that we did. We did connect with other companies that were further along on the journey. That was really helpful to get some hints as to how to go about this process. We also, speaking to getting buy-in, we developed a specific mission statement based on kind of all that information we gathered as to what our purpose was as to the credits that we would pursue and purchase. From there, we actually initially did a request for a proposal, and I would recommend that folks consider doing this, especially if this is your first time. We reached out to over 30 potential partners and looked at hundreds of projects, and it really helped us understand the market and begin to really hone in on the certain attributes and things that we were looking for, both in a partner but in a project. And so some of those things that we really focus on were, one, we wanted to go beyond just carbon benefits, so those kind of social or co-benefits that tied to the Sustainable Development Goals was really important to us and is important to us. We were interested in having more, having a partner that had kind of direct project involvement, and so some of that boots on the ground. We wanted the opportunity to talk directly to the partners. So in this case, of course, AFF and TNC. We also, we do go really deep in looking at the science. I'm very fortunate to have a colleague who has climate science background and really, dives into those details of the methodology. And I know Nate can attest to, the amount of questions and engagement we had there. So as far as to just the final buy-in, we engage partners obviously within my group, which is ESG public policy, but also worked with our sustainable finance partners as well to kind of come to decisions as we made purchases. And I know additionality has come up, and that is obviously one of our key kind of principles as well as we select partners.
Great, thank you, Beth. So we'll do one final question before I get to the audience questions. And as Cam, as you were talking, it was a question for Nate actually, but Cam, it occurred to me as you were talking, explaining your dynamic baseline methodology. So if the baseline shifts, then presumably the incentives to the landowners can also shift, and they could shift in what we could call the wrong direction, and that could change their decision about how they manage their forest. Of a quality attribute that we call permanence, it's usually the thing after additionality that people worry about most, and that's the hope or the need that the carbon actually stays locked up in the landscape. So Nate, tell us about how you can help investors or sorry, that the companies that buy these credits feel confident that you're scoring high on a permanence factor?
Yeah, thanks for the question. And it is a really difficult one. And I might just, as a general prelude, and in the theory that, one thing that we want everyone to take away from this is not just about the Family Forest Carbon Program, but how should you as a company assess natural climate solutions. One thing that would be a big red flag for me is if you ever heard a developer say something like, "Don't worry, we've got this all figured out," because they don't. No one does, right? It's a rapidly evolving landscape. We're all having to figure this out as we go. And also just the core activity, which is the management of very dynamic natural systems, is inherently complex, right? So with that as a prelude, let's come to permanence. All permanence means is if you're emitting, right, a ton of carbon dioxide into the atmosphere, it's going to stay there for a really long time. So if you're going to compensate for that with a carbon credit, the carbon credit has to stay in the biosphere for an equally long time, right? And the standards have basically coalesced around this limit of 100 years for permanence. You may also sometimes hear permanence described as durability, right? People like to use both words. And in general, we in this space like to come up with a whole bunch of confusing jargon, just as if the situation wasn't complex enough. So how do we approach permanence? Traditionally, the standards have done it using a group insurance approach, where every project takes a portion of their credits and sets them aside into a pool. The idea being that if any one project suffers a reversal or underperforms, that pool will sort of maintain the integrity of that project's credits. So you'll have some, just like any insurance, you'll have some projects that never need it, and you'll have some projects that need it a lot, and overall it will all balance. And just to be clear, that's a really great approach. We totally support that, and so we contribute to the VCS buffer pool, number one. But this is an example of, we feel like the regulatory environment and the demands for integrity are getting higher. So we have other approaches. Second approach is actually in the design of the program. So we look for interventions that meet a very specific criteria, which is they make sense in the long term, financially and environmentally, but they have cash flow consequences in the short term and technical challenges in the short term that we can help overcome. So that's the sweet spot for carbon credit finance, right? Is to come in and help a landowner through a transition period as they're switching from less sustainable practices that produce cash flow in the short term to more sustainable practices that produce cash flow in the long term. If you can help a landowner make that switch over the course of a 20-year contract, in the vast majority of cases, they would not switch back because they're actually hurting themselves financially even after the project is done. So by focusing on that kind of project, you can really reduce those permanence risks. So for example, you won't see the Family Forest Carbon Project do a lot of work in just pure like harvest deferral, just don't cut down your trees. Whether we want to transition people to a different method of harvesting or a different approach to harvesting that will produce long-term value for the landowner and for the climate. And then the third thing, this is our we don't know bucket, right, is we set aside 5% of all of our revenues into what we call the Permanence Fund. We invest those, they grow over time, and we have a number of theories about how we're going to deploy that fund to help maintain that climate benefit on the landscape. But the takeaway is this: ultimately, we are going to hold ourselves liable for the climate benefit we create. One of the things the Permanence Fund will absolutely fund is long-term monitoring. It goes way beyond the requirements of the VCS standard, right? So that we can actually see, here's the climate benefit we created. Is it persisting? Is it increasing? Is it decreasing? If it's decreasing, we have a pool of resources to sort of make those climate benefits whole. So that's the approach we're taking right now. But again, if you ask us next year, it will have changed because we'll have come up with new innovations.
Nate, I appreciate the honesty there. And I think this is exactly the way that we need to be looking at it, is that like buffer pools are great, but that's just the starting point. And if we can layer on additional insurance mechanisms, then this is just going to make the market more robust. So that's great to hear. Okay. We're going to move to audience questions. I would ask the panelists, there's so much to talk about here. I would ask the panelists to be as brief as they can. We have 42 questions. There's no way we're going to get through all of them. What I'll try and do is look for common themes in the questions and sort of group them together in that way. And hopefully as many of you as possible will have your questions answered. So one theme that I saw earlier is a bunch of people asking about, what about forest products? You know, this conversation has kind of been framed in terms of improved forest management, which I take to mean as like, don't go in and extract stuff. But that's probably simplistic. And people are asking, well, you know, what is the market for biochar? There's other kind of products you can make from wood residues. There's mass timber, for example. And these done right can actually have a beneficial impact on emissions. So how do you factor the potential benefits from those products within this program?
Cam, do you want me to take that first?
Yeah, why don't you go for it first? Sure.
Okay. What's basically happening in the United States right now regarding forestry is our forests are not producing timber as efficiently as they can. And here's why. Because you reach a certain point where it becomes more profitable for a landowner to, again, cut down their trees and take that short-term cash flow rather than continue to grow their trees to what would be like the maximal efficiency of producing timber products. And that just has to do with the time value of money, right? And cash flows. So one way of thinking about climate solutions in the context of working forests is, can we provide money that serves as a bridge so that those forests can continue to produce timber, and then that timber can still be harvested, but it will have produced more per acre, right? So we're basically increasing timber yields, which also increases carbon yields. Now, in the short term, there are trade-offs, right? I mean, you are going to be restricting harvests in some areas, but over time, the implementation of better silviculture is a benefit both for carbon storage and for timber production. So that they're really, this trade-off exists only if you look on like a time frame of a year or 5 years, maybe 10 years. But if you look 20, 30, 40 years, these lines begin to converge. And our program is entirely based on working forests, right? We're not creating set-asides. We're not creating easements where people can't harvest perpetually. And so we see those two things as needing to work together to create a sustainable climate future, but also sustainable economic future for these communities where, let's be honest, like timber products is a really important driver of those rural economies.
Hey, Jim, I might add just one quick thing there. So, Nate, those are all excellent points. And, you know, one other element of this, I think, that this raises for me is it's important for people to realize that these 11 million family forest owning households, many of them really suffer from a lack of investment in their forests. Forests are incredibly complicated. These are not professionally managed forests. 90% of these households have never had a forest management plan. And so this program is bringing investment to these families, to their forests, in a way that can help them actually improve the long-term timber yield and the long-term carbon sequestration and storage, because timber is made of carbon. So like Nate said, I mean, there are going to be some, temporal trade-offs with some forests at some times, but overall it's going to produce more carbon, and it's going to be a really big investment in these families. The last thing I always bring this up, but like I live in West Virginia. It's the second poorest state in the U.S. We have 100,000 family forest households in the state. 20,000 of them are below the federal poverty line. Like, let's get some investment in these families, and it will be done in a way that sequesters more carbon and helps them manage their forests with a long-term view, rather than, unsustainable harvesting that often happens because of an accident. Somebody has to go to the hospital, and you have an emergency, and you have to extract some value from your forest. So just wanted to add that.
Great. Yeah, great point. Thanks, Cam. So also seems some questions coming up about the Science-Based Targets Initiative. Beth, maybe this is a good one for you. A couple of people have noted that the net zero guidance from the SBTI that came out last year was pretty explicit that credits could only be used to offset the last bit of organizations' emissions once they've reduced emissions by 80 or 90%. So given those guidelines, how does the use of credits now, very few companies have reached that 80 or 90% mark yet, how does the use of credits now fit in with what the SBTI is arguing we should be doing?
Sure. So I am familiar with SBTI and what they put out for net zero guidance. I would just note that they have a special guidance that's in draft for financial institutions. So it will likely be a little bit different for my particular company. But, we as an organization, when we say we're committed to net zero, we're working towards that 80, 90% reduction before we would, look to make any kind of claim, whether it's our operations, supply chain, or the whole value chain. So, we're in agreement with that. We also are in agreement, I think, ultimately with SBTI in that when we get to net zero, we would be looking to neutralize those, unabated emissions using carbon removal credits. However, along the journey, we are very much utilizing all types of carbon credits, so reduction credits. And, we do believe that that is important and directly ties to, what IPCC is telling us needs to happen to get to net zero. And so, we, as I mentioned, we don't really hear about carbon neutrality that much anymore, but we had made that commitment and we had expanded it now to business travel. And I think you'll continue to see there's conversation around should there be a compensation or a contribution target that is, kind of goes hand in hand with reaching net zero and reducing the emissions. And so, we're very much following that and contemplating that. And, right now, I would say for us, we're continuing to invest in offsets and looking at, long-term investments for new projects like what we're hearing about today. And at the same time, we're investing in innovation, things like breakthrough energy that Bill Gates is using. So, we're kind of already starting to do that and may, very well have some kind of official target as SBTI continues to evolve their guidance. I hope that answers your question,
Thanks.
Jim. But...
It does. Thanks, Beth. Yeah, and there's lots more to say there, but I'm also conscious we've just got just over 10 minutes. I'm going to keep going, get in as many questions as possible. So we've had several questions come in about finance. I'm going to kind of lump them together, put this one to you, Nate. Give us a sense for the level of investment that you would like to see or that you think is needed to get this program to the scale where you would like it to be. And then tell us about what form that investment might take.
Yeah, that's a great question. So our big, hairy, audacious goal as a program, and TNC and AFF aligned on this in one of our first meetings, is 20% of family forest owners are signed up under this program or one like it, right, and are producing climate mitigation by 2030. If you could do that, you'd be producing between 60 and 75 million tons of mitigation annually. And over, a very short period of time, you'd get up into the gigatons. So it becomes a globally significant amount that you're contributing towards these global climate targets. Okay, what does that mean? It means about 100 projects of the scale of our first project, which, as Cam mentions, in the Central Appalachians. And it means roughly, don't hold me to this number, about $6 billion worth of investment, right? What is that for? It's for the technical assistance, the marketing to engage the landowners, and the incentive payments to give them that cash flow to enable them to transition to more sustainable practices. And we're talking about at least 150,000 landowners and probably 50 million acres. So it's a huge amount. Okay, now our goal is to get most of that from capital markets in the form of debt, right? So people on this call, you may be asking like, well, how can we help? There's basically three ways. Number one, we require a lot of research and development, right? So whenever we go into a new area, we have to figure out what are the practices that are going to provide this vaccine against bad forestry. I really liked how Cam described it like that, right? So there's a lot of science, there's a lot of modeling that goes into that. And then we have to test the program for a little bit of time. And all of that has to happen before we launch. So we're always looking for philanthropic partners, number one. Number two, you can sign a long-term offtake agreement where you say, basically, we agree to buy credits at a certain price over a certain period of time. And that's very useful for us because we can bring that to lenders, and that de-risks the project and allows us to get capital at the interest rates we need to be able to sustain the project. And number three, and we're seeing more and more companies have interest in this, you can almost make a kind of equity investment in the program where you invest a certain amount up front and you get paid back a share of carbon credits, right? And that's very useful because it reduces the need for other third-party investment entirely. So we've seen a couple companies make that move. So philanthropy, long-term offtake agreements, or what we call advanced market commitments, or the provision of upfront capital in exchange for carbon credits down the road. Those are kind of the three big ways that companies are currently helping the program.
Hey, Jim, I might add just one point onto Nate's excellent point there. So thinking about, giving some advice to companies on, how to sort between projects here. Part of the subtext of what Nate said there is all the innovation that's happening in the financial model for this program, which is very different than other projects out there. And we really need that to break through the supply bottleneck that we have. Like, the supply bottleneck is not going to go away without some real change. So as a buyer, I would consider at least asking programs, what are the new innovations that you're bringing to the space? We need it for science. We need it for engaging new land ownership groups like indigenous peoples and like family forest owners. And we need it for new financial models to drive investment into sort of underutilized NCS opportunities.
Great, thanks. Thanks, Cam. And Beth, did you want to jump in?
Jim, I was just going to put on my finance hat and just say, the importance of long-term contracts is, really to drive liquidity in this market, right? And to help kind of create a visual future price curve. And so, I think all of that is extremely important if we're going to scale this market.
Great, thank you. So I think we've got time for just a couple more. Had a couple of people ask about blockchain. We know there's a ton of activity right now in blockchain and related areas that seems now to be overlapping in some really interesting way with carbon markets. Really, anyone could tackle this. What do you see, particularly for this program, any potential to involve crypto technologies?
So I'm going to answer this just by, first of all, saying I know nothing about blockchain. I'm that person who, I've been to 100 seminars on blockchain and I still can't get it. But let me just say this. I do understand there are a lot of potentials for blockchain to help with issues of traceability, right? To make sure, again, it's just another way to increase the integrity of these credits. I do want to say one thing, though. A lot of energy in this space is devoted to, technological solutions, right? What I kind of jokingly refer to as push button get climate solution, right? And they're great. We use a lot of them ourselves. Remote sensing is the other big one that people talk about. They're all going to be helpful. But it's really important to me that everyone understands the technology that we need to utilize has existed for at least 13,000 years, right? And it's the technology of the relationship between communities to land. That is a relationship that has to change, right? And for that to change, we need to be able to work with people to help them understand what it would mean to do things differently. So I always want to gently, because I don't want people to understand me saying, like I'm a Luddite, blockchain can't help us at all. Of course it can. But blockchain, remote sensing, all these things won't be helpful if we can't have those conversations, human conversations about the way people relate to their force. And so that has to be first, then we can get to the ways that these technologies can help around the margins. Cam, Beth, do either of you know about blockchain and can actually answer the question?
I don't know. Well, I personally don't know a whole lot, but I do know that, traceability and considerations around global registries, and in particular, I've dealt with it a little bit with our renewable target and thinking through, we're installing a lot of on-site solar, but how do we really, track that and prove that we did not sell those RECs to someone else? And so that's where I think blockchain, could have some, Oh, go ahead,
Well, we
Jim.
actually had no, we had a question that comes from the traceability issue and requires no technical knowledge to answer, or minimal, and that's about what happens to these credits. We know that some credits are purchased by speculators and some are purchased by companies and retired. What sort of mechanisms are there in place to make sure that these credits actually are retired and therefore have the impact we want them to have?
I don't know if one of the men wanted to take that question. I was going to say Nate.
Or Cam?
I think
Nate, why don't you,
Cam can answer the... Yeah, go ahead, Cam.
Or go ahead. Yeah, why don't you go first and I'll go second. Yeah, two parts to it.
So I'm going to defer to Cam on like the logistics of what happens with the credit. What I will say is that we intend to sell all of our credits to the end users who will then retire them. And we write some of that into our contracts. You can't 100% guarantee that, but that's our intention, is we don't want to sell into a speculative marketplace. We want to sell to the end user, make sure those credits are retired against a climate goal that has integrity behind it.
Yeah, I guess I would just support that statement as an intention of what we're generally trying to do. I mean, we do want to make a more liquid, efficient market, but we want the value that's being generated by these credits to go into climate solutions and communities. So yeah, I mean, I think generally, right, the end user will retire the credit to help them to help them neutralize that carbon emissions that they have generated. And I think if we have that shorter sort of line from the forest to the end user, that controls a lot of those risks.
Mm-hmm. And I would
Thank you.
add,
oh, sorry, Beth, go.
Oh, no, I was just going to say, as a corporate user, obviously you get an attestation, showing what's been retired on your behalf. And then in your reporting, I would suggest that everyone have it third-party verified as well. So you've got that additional review.
Thank you for clarifying. Let's just try and squeeze in one more question. If there's probably one for you, Cam, if you can be really brief. Had a number of people ask about different areas in which this dynamic baseline approach could be applied. People have mentioned oceans, agricultural credits as well. Do you see potential there?
Yeah, definitely. I think, I think we see potential in really any space out there. And maybe I didn't emphasize this earlier, but, the verified carbon standard had to literally rewrite parts of the standard to accommodate this because it was sort of over the horizon from what people could envision a few years ago. And I love that happened because it creates the incentive and the framework to have innovation and others create new methodologies for oceans, for, whatever reforestation. Actually, there's a new VCS reforestation methodology, which took the lessons from this one, adapted them, and now it's a dynamic baseline built into that as well. So I think this is where a lot of the market is going, and a lot of the folks on this call can help provide that signal for higher integrity.
Thank you. Definitely an area we're going to watch with interest. And I'm really sorry, but that's all that we have time for today. I know there were just so many questions, well over 50. We didn't get to everything that was raised. Hopefully there will be a chance for the speakers to connect with the questioners later and follow up. But I really want to thank all of our speakers for what was a really, really lively and fascinating conversation. And thanks also so much to our webcast sponsor, the American Forest Foundation, for making this webcast happen. If you do have time, please take the short survey that you can find a link to in the toolbar at the bottom of your screen. That would really help the foundation. If you'd like to rewatch this broadcast, the recording will be archived on greenbiz.com, and our team will email you the link once it's available later today. You can also check out the resources on this topic by clicking on the resources button on your screen. And this includes, as well as the webcast slides, a link to subscribe to the GreenBiz Group's Climate Tech Weekly newsletter, which provides updates on the latest technologies and trends accelerating the clean economy, and also a link to register for GreenBiz 22, the premier annual event for sustainable business leaders that's been hosted in Scottsdale, Arizona next month from the 15th to the 17th. If you'd like to watch more GreenBiz webcasts, please visit www.greenbiz.com/webcasts. And I'll just finish by saying on behalf of all my colleagues here at GreenBiz, thanks so much for joining us today. My name's Jim Giles, and I hope to see you at a GreenBiz webcast in the near future.